Introduction: Daily Life is Forex. Welcome to the ultimate Forex trading masterclass. If you are just starting your journey into the world of trading and investing, this beginner series is designed specifically for you. Forex might seem like a complex, distant financial concept, but in reality, it is something that directly affects almost every single aspect of your daily life, whether you realize it or not. If you have any trading topics you'd like to discuss, just press 2 inches, comment, I'll clear things up for you. Think about your morning routine. When you buy your morning cup of coffee, the price of those imported coffee beans is influenced by exchange rates. When you pull up to the gas station to refuel your car, the cost of oil is priced globally in US dollars, directly impacting what you pay at the pump. Even when you save up money to go on a holiday abroad, you have to exchange your local currency for the currency of your destination. All of these everyday activities are made possible through the global movement of currencies. Daily life is Forex in motion. To help you master these concepts, we have created a free Forex trading room. We will show you how to trade it later in this lesson, but for now, let's start with the basics. What exactly is Forex? Part 1. The decentralized market structure. Let's break down the word itself. The word Forex is a simple mashup of the words foreign and exchange. It is commonly used to refer to the foreign exchange market, which is officially the largest, most liquid financial market in the entire world. To put its scale into perspective, imagine a massive global marketplace operating continuously across every corner of the globe. However, unlike a traditional retail store or a supermarket, this marketplace has no physical goods on sale. Instead, this market trades exclusively in global currencies. With a staggering daily trading volume of over $6 trillion, the Forex market absolutely dwarfs the stock market. Furthermore, unlike the stock market, which has strict opening and closing hours, the Forex market is open 24 hours a day, 5 days a week. This continuous operation runs from 5 p.m. Sunday to 5 p.m. Friday Eastern Time. Now, where exactly is this giant market based? The answer is everywhere and nowhere. Forex is a completely decentralized market. This means there is no single central authority, exchange, or physical building that governs the transactions. Instead of a central exchange like the New York Stock Exchange, the Forex market is made up of a massive global network of central banks, commercial banks, retail brokers, institutional dealers, and governments who all trade currencies directly with one another over the counter. This interbank network operates seamlessly across different time zones, ensuring constant liquidity. Part 2. The ISO codes and currency pair mechanics. To navigate this market, we must understand how currencies are represented. In Forex, every currency is represented by a standardized 3-letter code known as an ISO code. Let's go through the major currencies traded globally. First, we have USD, which is the United States dollar, often referred to simply as the dollar. Next is AUD, the Australian dollar, commonly known as the Aussie. We also trade NZD, the New Zealand dollar, known as the Kiwi. Then we have the Euro, representing the Eurozone's Euro. CAD is the Canadian dollar, nicknamed the CAD. GBP is the British pound, also called the pound. JPY is the Japanese yen. And finally, CHF is the Swiss franc, often referred to by traders as the Swiss. Now, what is a currency pair? In the Forex market, currencies are never traded in isolation. They are always traded in pairs. This is because whenever you make a Forex transaction, you are buying one currency while simultaneously selling another. Let's look at the GBP-USD currency pair as our primary example. The first currency in the pair is called the base currency, and the second is the quote currency. If you receive a quote of GBP-USD at 1.2655, this tells you exactly how much of the quote currency is needed to buy 1 unit of the base currency. In this case, 1 British pound is equal to 1.2655 US dollars. Remember, there is always an invisible number 1 sitting next to the base currency on the left. When you execute a buy order or go long on the GBP-USD, you are speculating that the British pound will appreciate in value while the US dollar will depreciate. Conversely, when you execute a sell order or go short, you are expecting the British pound to depreciate while the US dollar gains strength. Part 3. Pip, pipette, and lot size mathematics. In Forex, how do we measure the change in currency value? We use a standardized unit called a pip. PIP stands for percentage in point or price interest point. It represents the smallest whole unit price movement that an exchange rate can make. For most major currency pairs, the exchange rate is written to 4 decimal places, and the 4th decimal place represents 1 pip. For example, if the AUD/USD moves from 0.6751 to 0.6752, that is a 1 pip gain. However, there is a famous exception, JPY cross pairs. The Japanese yen is quoted to only 2 decimal places, meaning the 2nd decimal place represents 1 pip. If USD JPY moves from 146.22 to 146.23, that is a 1 pip movement. We also have fractional pips, called pipettes, which are represented by the 5th decimal place, or 3rd for JPY pairs. A pipette is equal to 1/10 of a pip. Next, let's look at how we measure the volume of our trades. Positions in Forex are measured in lot sizes. Buying and selling currencies requires standardized contract sizes. A standard lot is equal to 100,000 units of the base currency. A mini lot is 1/10 of a standard lot, representing 10,000 units. A micro lot is 1,000 units, and a nano lot is 100 units of the base currency. Part 4. The spread, brokers, and leverage mechanics. Every time you trade, you will see 2 different prices, the bid and the ask. The bid price is the price at which your broker is willing to buy the base currency from you, meaning this is the price you sell at. The ask price is the price at which the broker is willing to sell the base currency to you, meaning this is the price you buy at. The ask price is always slightly higher than the bid price. The difference between these 2 prices is called the spread. The spread is essentially the transaction cost you pay to enter the market. This spread covers the broker's or dealer's profit and the costs of facilitating the transaction. Spreads can vary significantly from broker to broker, and they can be fixed or variable depending on the market conditions. Now, as an individual retail trader, you cannot trade directly on the interbank network. You require a broker to act as your gateway to the market. To help you trade larger positions, brokers provide leverage. Leverage is essentially using borrowed capital from your broker. It acts as a financial lever, magnifying your trading power. With leverage, you can control much larger positions with a relatively small deposit, known as margin. Ratios can vary, such as 150, 1 to 100, or even 1 to 500. For instance, with 1 to 100 leverage, a $1,000 deposit allows you to control a $100,000 position. However, remember that leverage is a double-edged sword. While it magnifies your potential profits, it equally magnifies your potential losses. Part 5. Liquidity, volatility, and the analysis styles. 2 final, essential concepts you must know are liquidity and volatility. A highly liquid market means there are a vast number of active buyers and sellers, making it incredibly easy to execute trades quickly and with minimal slippage. Think of Forex as a vast ocean. A single retail trade is like dropping a tiny pebble into that ocean. It barely makes a ripple. Conversely, volatility refers to how rapidly and dramatically price changes. High volatility means prices are swinging up and down in large amounts, like a wild roller coaster ride. This represents more risk, but also far more profit potential. Volatility is driven by macroeconomic factors such as inflation, central bank decisions, geopolitics, and interest rates. So, how do traders make sense of all these movements? They employ 2 primary methods of analysis. The first is technical analysis, where you study historical price action, patterns, and indicators to predict future trends. The second is fundamental analysis, which focuses on the economic and political health of a country to determine currency value. A professional trader understands how to use both. As promised, you can join Forex Trading Room by clicking the link in the channel description below. This guide contains everything we covered today and more, giving you a solid reference guide as you practice. If you found this lesson valuable, please hit the like button, subscribe to our channel, and comment below with what topics you want us to cover in our next video. Stay disciplined, study hard, and we will see you in the next masterclass. If you have any trading topics you'd like to discuss, just press 2 inches, comment, I'll clear things up for you.